Hello, and welcome to Tax Update 25, brought to you by Tax Essentials for Advisors. I'm your host, Andy Rainford, fresh back home from a complete washout at Alton Towers yesterday. At least the queue times were short. This episode covers the government's cut to VAT on certain children's activities this summer, guidance on how averaging elections will work under Making Tax Digital, and a case involving grazing sheep and its effect on stamp duty land tax. The government has announced a temporary reduction in VAT from 20% to 5% on certain children's meals, children's admission tickets, and qualifying family attractions as part of the government's Great British Summer Savings Package. The reduced rate will apply between the 25th of June and the 1st of September 2026 and is intended to help reduce the cost of family activities during the school summer holidays. The measure covers children's meals served in restaurants and cafes, children's tickets to cinemas, theatres, concerts and exhibitions, and admission to a wide range of family attractions such as theme parks, zoos and soft play centres. While the announcement may be welcomed by families, the practical challenge falls on businesses, many of which will need to update pricing structures, payment systems and VAT processes at short notice. There are also complexities around family tickets, bundled supplies and advance bookings. For advisors, this is a useful reminder to contact affected clients early to ensure systems are ready before the reduced rate takes effect at the end of June. In another move, the government has published a substantial technical note providing further detail on the inheritance tax changes affecting pensions from April 2027. As announced in the government's reforms, most unused pension funds and pension death benefits will be brought within the scope of inheritance tax. This represents one of the most significant changes to estate planning in recent years, given that pensions have traditionally sat outside the inheritance tax net. The technical note focuses on how the new rules will operate in practice. It explains how pension benefits will be valued, how inheritance tax liabilities will be calculated and allocated, and the respective responsibilities of personal representatives, pension scheme administrators, and beneficiaries. The note also confirms plans for a pensions direct payment system, allowing pension schemes to pay the tax directly where appropriate. However, the overall process is likely to become considerably more complex, particularly where there are multiple pension arrangements or different beneficiaries for the estate and the pension funds. For advisors, the key message is that clients with significant pension wealth should review their estate plans well before April 2027. The traditional strategy of preserving pension funds for the next generation may no longer deliver the same inheritance tax advantages under the new regime. HMRC has issued an important clarification on the interaction between Making Tax Digital for income tax and claims for averaging relief. The key point is that not everyone who claimed averaging relief in their 2024-25 tax return will automatically be exempt from MTD when it becomes mandatory. For sole traders, the position remains relatively straightforward. If averaging relief was claimed using the self-employment pages, the exemption is automatic for 2026-27. However, HMRC has changed its guidance for partnerships. Partners who claimed averaging relief through the partnership pages are no longer treated as automatically exempt. Instead, they must make a separate application if they wish to rely on the exemption. While partners are not within the scope of MTD due to having partnership income, it will still be relevant if they have other qualifying income that exceeds the threshold. The same applies where a taxpayer expects to make an averaging relief claim in a future year, but has not yet done so. For advisors with farming, market gardening or creative sector clients, this is a useful reminder to review MTD readiness and ensure that eligible clients do not miss out on an exemption simply because they assumed it would be applied automatically. We now have a timetable for rolling out mandatory multi-factor authentication for tax agents accessing online services. The change forms part of HMRC's wider program to improve cybersecurity and protect taxpayer information. Under the new arrangements, agents will be required to verify their identity using an additional authentication step when accessing their government gateway accounts. For many firms, the practical impact may be limited, particularly where MFA is already used across other systems. However, the announcement is a useful reminder to review existing access arrangements and ensure that login credentials are managed appropriately. This may be particularly relevant for practices that still rely on shared credentials, generic accounts, or legacy processes that were designed before multi-factor authentication became commonplace. Although the change is primarily a security measure, firms should take the opportunity to test access procedures and ensure staff are familiar with the new requirements before they become mandatory. Overall, this is another step in HMRC's ongoing digital transformation program and reflects the increasing focus on protecting sensitive taxpayer data from cyber threats. This was another SDLT mixed-use case. The taxpayers bought a farmhouse with around 16 acres of land, including a field that had been grazed by a neighbouring farmer's sheep for many years. They argued that this agricultural use meant the property was mixed use rather than wholly residential. The tribunal disagreed. The grazing arrangement was informal, no rent was paid, and the arrangement was really a convenient way of maintaining the land rather than a separate commercial activity. As a result, the field was treated as part of the grounds of the dwelling, and the residential SDLT rates applied. The practical point is that informal grazing arrangements will not necessarily be enough to secure mixed-use treatment. Taxpayers will generally need evidence of a genuinely separate and identifiable non-residential use. This case concerned an application for closure notices. The taxpayer argued that HMRC's inquiries had been running for a long time and asked the tribunal to direct HMRC to bring them to an end. HMRC maintained that further inquiries were still required before it could reach final conclusions. The tribunal refused the application, finding that there were still relevant matters that there was still an entitlement to investigate. The key takeaway is that the age of an inquiry by itself is usually not enough to obtain a closure notice direction. The taxpayer must show that HMRC no longer has reasonable grounds for keeping the inquiry open. That's it for another week. I'll be back with another update toward the end of the month. From me, Andy Rainford, and the team at Tax Essentials for Advisors, it's goodbye for now.
Thanks, Andy. I'm glad you've dried off. Just a quick reminder that the registration for our next free CPD webinar is now open at the link shown here. Andy and Rachel will be joined by VAT expert Ed Thompson for a session around planning with the option to tax. It's sure to be full of useful tips, so do join us if you can.